Tasmania, is it Australia's hidden gem for property investors, or is everyone avoiding it for a good reason? I flew down here to find out, and what I discovered completely changed my perspective. I'm Oliver from Insight 2, and I've spent the last couple of days on the ground here in Tassie, driving through the burbs, meeting with the local agents and digging into the data that most investors never see. Now, let's face it, this isn't a desktop research. This is boots on the ground, done well. Here's what we're covering. First, the economic reality of the Tassie, population, jobs, and what the numbers actually say. Then we'll look into infrastructure that's quietly transforming this state. And third, we'll compare Hobart, Launceston, and Devonport head to head. And finally, my verdict on whether Tassie deserves a place in your portfolio or simply stay far away on mainland Australia. I came here skeptical. I thought Tassie was too slow, too small, and too isolated. But what I found on the ground actually surprised me, and I think it might actually surprise you too. Let me be honest with you and upfront, Tassie has the smallest economy of any Australian state. The GSP is 42.8 billion, growing at just 1%. The population growth is the slowest in the country at 0.21%. And here's a stat that scared me the most. Tassie has had 13 consecutive quarters of net interstate migration losses. People are leaving. It's an aging population. What surprised me? We are bang on in a cracking summer, and the weather is actually worse than Melbourne, with a puffer jacket on, blowing at 10 chilling degrees. Here's where it gets interesting. Employment grew 2.7% last year, and that's stronger than the national average. And employment is at 4%, actually better than most states. And the industries driving this aren't dying. We've got healthcare at 15%, public administration and education is at 13%, agriculture 11%, and these are stable, recession-resistant sectors. But here's a key investor takeaway. The compensation of employment grew at 7% in 24 to 25. That is signaling wage momentum, improving serviceability, and better rent collection resilience. The job growth has been led by my favourite, healthcare, followed by construction and tourism. While manufacturing and forestry have actually shed roles, for property investors, this environment supports a little bit more of a stable tenants, lower areas risk, and rental resilience, but it does not support aggressive leverage on speculative growth assumptions. What surprised me the most was how these streets felt small, historical, quaint, but active enough for local cafes and people activity to happen. The numbers here, you can see the real activity led by an aging population predominantly, and the hustle and bustle coming through the tourism sector. Here's the old pill to swallow. Out migration is concentrated in that 25 to 45-year-old group together with their families. Interstate migration is skewed towards retirees. From 26 onwards, deaths are expected to exceed births over years. This doesn't mean Tassie collapses, but it does mean household formation slows. Demand growth becomes very location specific, and regional markets becomes a little bit more vacancy sensitive. So this is why Tassie punishes lazy investing. Tassie isn't growing as fast, but it's growing efficiently. Over the past decade, Tassie's real economy expansion totals to 26%, and that's broadly matching New South Wales and Victoria, and quite silently outperforming South Australia, despite being the smallest economy in the country. What's underappreciated here is its resilience. Tassie held up during the COVID years and this national slowdown in 2023. And we ask why? Largely because of the counter-cyclical public expenditure and export-led agriculture and energy. For property investors, this matters because smaller economies are a little bit more vulnerable to shock, but Tassie has historically demonstrated an ability to smooth this cycle. Now, that doesn't create the boom, but it does reduce the bust risk of property markets. This is the point where Tassie stopped looking like that sleepy island and started looking like a place with a forward-looking plan. This might be harsh, but this is what changed my mind about Tassie. The Bridgewater Bridge just completed $786 million to fix a bottleneck. That's the frustrated Northern Corridor for decades. The Macquarie Point Stadium is a $1.13 billion commitment that's ongoing to transform Hobart's waterfront. And the Aqualink Port expansion is $240 million that positions Tassie as a genuine economic gateway. When you see government infrastructure investment at this scale, it simply tells you something. This isn't a state that's given up on growth. This is a state that's betting on its future, on forward planning. What this tells me, government simply doesn't spend this kind of money unless we believe in future growth. And the population and the locals that I spoke with, from tradies to town planners to cafe owners, they can slowly start feeling that momentum pick up. Super exciting news. As of Jan 2026, part of the $219 billion nationwide Commonwealth hospital funding, guess what? Tassie gets an extra $700 million in healthcare. To put that in perspective, that is super exciting health infrastructure for future growth planning in Tassie. Let's zoom out and look at the markets across the major centres. Let me give you the lay of the land. Right here, right now, Hobart's your premium play in the heart of Salamanca markets. Median price of about $780, a gross yield hovering about the 3.6, grown over the past 5 years, 38%. Launceston has a median price of $550, the yield of 4.1, grown at 46% over the past 5 years. Devonport, around at 460 to 480, a yield hovering of low 5%, grown at 40%. Hobart is a premium play at a higher price, low yield. Launceston gives you a little bit better growth in yield, and Devonport, that is simply the cash flow story at a sub-entry of 500k. That is exactly what we saw at Open Homes. It's a kind of market that isn't sexy, but it's quite reliable. Now let's be honest, it's chilly down here. It's not all sunshine. These are 5 key warning signs. Number 1, population exit. 13 consecutive quarters of negative interstate migration. Number 2, flood risk. Multiple suburbs have significant exposure, insurance costs, and added maintenance. Number 3, limited liquidity, markets of fewer buyers when you want to exit. Number 4, economic concentration of somewhat a heavy reliance on government and agriculture. Number 5, rental compliances and additional hauling costs. Now, I'm not going to sugarcoat this. Tassie has some real risks that you've got to understand. The population is literally shrinking from interstate migration. Some suburbs have some serious flood exposures. We drove around through the streets, we walked around, we definitely did see the waterline markers from previous floods. And when you want to sell, this isn't simply Sydney or Melbourne. With an exit out, there are fewer buyers, which means less negotiating power. So here's my verdict. Tassie isn't for everyone. If you're chasing rapid capital growth and need to flip in the next couple of years, look elsewhere. If you need maximum liquidity and the ability to exit quickly, this isn't your market. But if you're a buy and hold investor who values the affordability, the yield and livability, Tassie offers some genuine, unique entry prices that simply do not exist in comparison to the mainland. Yields actually start making a little bit more sense here, and the quality of life that attracts a certain type of residents, from professional to retirees, also to lifestyle seekers who aren't really going anywhere. Hobart remains Tassie's most defensible investment market at a much more premium price. Why? You've got concentrated employment, you've got persistent low vacancy, and you simply have limited new housing supply with a strong public sector wage base. This is where the yield stability and the capital growth preservation market kicks in. It's not a boom market. You can enhance that with some value add strategies, which are quite simple: layout optimization, functional upgrades. I'd be very cautious of subdivision and dwelling upgrades due to the hilliness of Hobart's landscape. Launceston is a more selective. You've got good fundamentals near the hospitals, university precincts, and the employment corridors. But let's face it, also a weaker population momentum means street by street selection is quite important. Oversupply on certain fringe areas can stall quickly, so it is simply important to be doing your right due diligence. This is a selective income play and simply not a blanket buy in Launceston. Devonport is the most volatile. It's infrastructure and energy projects that can drive a short-term rental pressure with construction-linked demand. But long-term growth is capped by an aging demographics, project dependency, and smaller resale pool. Now, this is a market that rewards discipline, where you're buying and you're wanting to buy below replacement costs, where you're protecting your yield and you're not simply relying on capital growth appreciation. Tassie rewards precision and punishes speculation. You can't just buy anywhere and expect results. If you pick the right suburbs, the right streets, the right property type, there is genuine opportunity here that a lot of mainland investors are now slowly starting to see. So there you have it. If you want help navigating the Tassie market or any market across Australia, you guys know what to do. Book in a call, let's jump in a chat with myself, and we'll help you figure out if Tassie fits your portfolio, and if it does, exactly which pockets would be boosting that portfolio of yours for the long-term wealth generation.